distinguished guest, the Governor of the Bank of Canada, Tiff Macklem. Governor Macklem has dedicated his career to shaping Canada's financial and economic landscape. Since his appointment as Governor of the Bank of Canada in 2020, he has led the bank through some of the most turbulent economic times in recent history, steering monetary policy through inflationary pressures, global uncertainty, and now, of course, shifting trade dynamics. His deep experience extends beyond our borders. As chair of key international financial groups, including the oversight body of the Basel Committee on Banking Supervision and the Financial Stability Board's Vulnerability Assessment Committee, he helped support global economic stability. We couldn't use you more now. He is also a former dean of the Rotman School of Management, helping to shape the next generation of economic leaders. Governor Macklem's leadership has been tested before, and with the development south of the border, he is leading us through new and uncertain times. So, ladies and gentlemen, please join me in welcoming Governor Tiff Macklem to the Blue Sky City.
Well, Geraldine, Joe, thank you very much for that introduction. And it's great to be in Alberta. Thank you for having me. Thank you to Calgary Economic Development. The last time I spoke in Calgary was about 18 months ago. It was September 2023. The post-pandemic crisis was easing. Uncertainty, yes, uncertainty remained, but it was coming down. Inflation was still above 3%, and the Bank of Canada's policy interest rate was 5%. Canadians were being squeezed by still elevated inflation and higher interest rates. I think the question on everybody's mind, including ours, was could we get inflation back to our 2% target without tipping the economy into recession? Well, as 2024 closed out, this question was largely resolved. Inflation was on target, and economic growth had picked up. The Canadian economy was in good shape. Inflation came down through the first half of last year and had been close to 2% since last summer. As the bank's governing council became more confident that inflation was on track to return to target, we began reducing our policy interest rate starting last spring. Substantial rate cuts through the rest of the year boosted household spending, and economic growth picked up to 2.2% in the third quarter and 2.6% in the fourth quarter. Employment growth also strengthened in November through January, and the unemployment rate came down. The Canadian economy managed a soft landing. Unfortunately, we're not going to be on the tarmac for very long. We now face a new economic crisis. Since President Trump began threatening to impose a wide range of tariffs on Canadian exports, uncertainty has increased sharply. And depending on the extent and duration of tariffs, the economic impact could be severe. The uncertainty is already causing harm. There's a lot we don't know. Some new tariffs are in place on steel, aluminum, as well as goods not in compliance with the Canada-US-Mexico agreement. We don't know how long these tariffs will last. And we don't know if tariffs will broaden to other sectors. In the last 2 months, the U.S. administration has twice imposed and then retracted universal tariffs on all imports from Canada and Mexico. President Trump has also threatened to extend tariffs to a wide range of industries, including autos, semiconductors, and pharmaceuticals. And he has repeatedly said new reciprocal tariffs are coming on April 2nd on many countries, although it's really not clear exactly what that means. Most disturbing of all for Canadians, President Trump has threatened our sovereignty, repeatedly referring to Canada as the 51st state. There can be no question about our sovereignty or our border. Last month, I gave a speech about the effects of broad-based tariffs on the Canadian economy. And today I want to advance the discussion in 3 ways. First, I want to discuss what tariffs could mean for specific sectors and specific regions of the country. Second, I'll talk about the impacts of uncertainty caused by on-again, off-again tariffs and threats of more to come. Canadian businesses and households are doing their best to navigate the unpredictability of U.S. policy. That uncertainty is affecting our economy. And finally, I'll talk about how the bank is navigating monetary policy in the face of unusual uncertainty. Monetary policy cannot solve a trade war, and we can't make the uncertainty go away. But we can make sure that we don't add to it by ensuring inflation remains anchored on our 2% target. Canadians are worried about trade uncertainty. We don't want them to worry about inflation as well. So, with that, we've got a lot of ground to cover. So here we go. In my speech last month, I outlined how the universal tariffs on Canada and Mexico that were threatened by President Trump could impact the Canadian economy. I outlined the channels and broad impacts of a 25% tariff on non-energy exports, 10% on energy, together with the retaliatory tariffs proposed by the Canadian government. Our economic models predict that exports and business investment would decline sharply. The economy would work less efficiently, and we would earn and consume less. Higher tariffs would also increase prices, causing inflation to rise for a period, as the upward pressure on prices from higher costs would outweigh the downward pressure from a weaker economy. Since that speech in February, the level and timing of tariffs have changed several times, and there are far too many unknowns to predict what happens next. But we do know that the tariffs and the uncertainty, if they are maintained, will particularly hurt a few key sectors. And that will have a big impact on Canada's regional economies, including here in Western Canada. Now, as those of you in the room know all too well, for Alberta, the hit to the energy industry from a 10% tariff is a major concern. It's also a big issue for Midwest U.S. refineries that have invested heavily in equipment to refine heavy Canadian oil. Roughly 94% of Canadian crude oil exports go to the United States, mostly through north-south pipelines. The launch of the Trans Mountain expansion pipeline has increased the access of Canadian oil to overseas markets, and new LNG export capacity is coming online. And this is helping to diversify the markets for Canadian energy exports. But these investments were designed to augment our export capacity, not replace U.S. demand. Looking ahead, U.S. tariffs could put downward pressure on Canadian energy prices and reduce the profitability of Canadian energy producers, at least until other markets can be expanded. The hit to profits combined with uncertainty means that investment will likely drop and employment could follow. I know Albertans have lived through the boom and bust commodity cycles before, indeed for many generations. But a threat to the Canada-U.S. energy relationship is not something we've ever had to contemplate. The other prairie provinces are also being affected. The United States has temporarily exempted fertilizers, including potash, from tariffs, and they've lowered the planned tariffs from 25% to 10% for non-compliant exports, but uncertainty remains. Spring seeding will soon begin, and farmers on both sides of the border are already feeling pressure from low grain prices. U.S. farmers import potash from Saskatchewan to add potassium to their soil. Canadian farmers often need U.S. phosphate to fertilize their crops. Other tariffs will have impacts too. Canadian farmers buy a lot of machinery and equipment from the United States. And China has said it will impose a 100% tariff on Canadian canola oil and meal effective today. China is the top market for Canadian canola. The export value is close to $5 billion. It's a very difficult situation so close to planting season and adds to the uncertainty Canadian farmers are already facing. Other parts of the country, particularly Ontario and Quebec, will be disrupted by 25% tariffs on steel and aluminum. In 2024, the United States imported a quarter of its steel and 40% of its aluminum from Canada. Canada imported a quarter of its steel and a fifth of its aluminum from the United States. These cross-border flows mean that these sectors will be hit by both U.S. tariffs and counter-tariffs. It's going to hurt output, and it's going to raise prices. Now, monetary policy cannot target specific industries or regions. We have one monetary policy for the country. But to assess the overall implications of new tariffs, it is critical we understand their impacts industry by industry and how this is affecting and spilling over across regions. The bank's regional offices across the country in Halifax, Montreal, Toronto, Calgary, and Vancouver gather economic intelligence across industries and economic regions. And I'm very pleased to be joined by Farouk Suvankanlov, head of our Calgary regional office, which covers the Prairies and Northwest Territories. Our Calgary office is actually our second largest after our headquarters in Ottawa. Now, beyond the impacts of tariffs, the pervasive uncertainty created by the sudden and unpredictable shifts in U.S. trade policy is affecting both the Canadian and the U.S. economies. Trade policy uncertainty measures such as this one shown in Chart 1 have spiked in recent months. After more than 50 years of highly predictable trade policy, there was a sharp increase in uncertainty during President Trump's first term in office. But that uncertainty doesn't come close to what we see now. There are at least two kinds of uncertainty related to U.S. tariffs. There's uncertainty about the tariffs themselves, which tariffs will actually come to pass, and how long will they last. There's also uncertainty about the economic impacts of tariffs. We've not had to grapple with such large, broad-based tariff increases since the 1930s. So let me elaborate. Consumer confidence has fallen sharply in both Canada and the United States. After recovering through last year, the Conference Board of Canada's Index of Consumer Confidence fell to its lowest level on record in March, amid the chaos around U.S. tariffs. And the University of Michigan survey of U.S. consumers also declined, with sentiment now at 2.5-year lows. Last week, the Bank of Canada published new survey data on what we're hearing from households and businesses. Canadians told us they have become more worried about their jobs and financial security, and they intend to pull back on their spending. That's particularly true for workers in industries that rely on trade, including manufacturing, mining, oil, and gas. Businesses have lowered their sales outlooks, notably in manufacturing and in sectors that are sensitive to consumer spending. Some businesses report that credit has become harder to access. And with a weaker Canadian dollar, the cost of imported machinery and equipment has risen. Businesses are telling us they are delaying or canceling investment projects, and they're scaling back on hiring. Uncertainty is also affecting businesses' pricing decisions. Businesses have told us they face new costs associated with sourcing new suppliers, finding new markets, and managing their inventories. The majority of businesses plan to pass on these costs, as well as the direct costs of any new tariffs, to the prices of the goods they sell. Our surveys also find that near-term inflation expectations have risen in Canada as businesses and consumers brace for higher prices. Short-term inflation expectations of U.S. consumers have also risen materially for the first time since 2022. Finally, this uncertainty is taking a toll in financial markets. Equity prices are down sharply in the last few weeks, particularly in the United States. U.S. stock market indices have fallen about 10% from their recent peaks, and bond yields in both Canada and the United States have come down. Markets are revising down their growth outlook for North America. The damage caused by tariff uncertainty has started on both sides of the border. Now, even if and when we know what tariffs will be imposed, it's going to be hard to know exactly how consumers and businesses will react. It is clear that higher tariffs mean less demand, they mean weaker growth, and they mean higher inflation. The mechanics of tariffs are straightforward. tariffs on Canadian exports will be paid by the U.S. company buying those goods, and that company will pass at least some of the cost onto U.S. consumers. The same goes for retaliatory tariffs on goods Canada imports from the United States. What is less clear is how much tariffs will dent demand and how much of the tariff will get passed on to consumer prices. Will U.S. buyers continue to buy imported Canadian goods when tariffs are added to the bill? Well, if you're buying something that you can't get anywhere else, well, maybe you're willing to accept a 25% price increase. But even then, you're going to buy less of it. And if there are substitutes for the thing you're buying, well, you're going to switch, and Canadian exports could fall a lot. The impact of tariffs on consumer prices will be affected by the strength of demand. In our recent survey, about half of businesses said they intended to raise prices as they cope with higher costs related to both tariffs and uncertainty. And 3/4 of those said they would pass most of the cost increase on to their customers. Now, these intentions may change as economic conditions evolve, and we're certainly going to be monitoring business intentions closely. The uncertainty about the pass-through of higher costs to consumer prices is of particular importance to monetary policy. Our mandate is price stability. Low inflation is the best way we can support Canadians in good times and in bad. So we're watching closely how the costs of tariffs and uncertainty pass through to consumer prices. This chart, Chart 2, illustrates the sensitivity of inflation to different assumptions about the speed at which higher tariffs pass through to prices. In all three cases, we assume 100% pass-through, but we vary the speed from 1 year to 3 years. And what you can see is that, well, first of all, before I get to that, just to be clear, different goods are going to have different pass-throughs. So, for example, fruits and vegetables any tariffs will likely get passed through very quickly, almost immediately. These are perishable goods. Prices of more complicated goods with different components and longer-term contracts, the pass-through there will tend to take more time. Our focus is really on the overall response. And what you see in this chart is that faster pass-through, the blue line, means inflation would rise by more, but it would also come down faster, provided monetary policy is doing its job. Slower pass-through, the red line, means inflation doesn't rise as high, but it remains elevated for longer. In all three cases, monetary policy responds with the goal of ensuring that inflation returns to target over time. The more inflationary the impact, the less scope monetary policy has to support the economy. Instead, it needs to put more focus on anchoring inflation expectations, which risk drifting up when inflation rises more and more quickly. So now let me turn to my third topic, how the Bank of Canada is navigating tariff uncertainty. À la base, notre point d'ancrage est notre cadre de politique monétaire, c'est-à-dire notre cible d'inflation de 2%. On ne peut pas résoudre l'incertitude liée au commerce, mais notre engagement à maintenir l'inflation à un niveau bas ne doit faire aucun doute. Les Canadiennes et les Canadiens doivent avoir confiance qu'on va maintenir la stabilité des prix, même pendant les bouleversements mondiaux. On sait que certains prix vont augmenter quand les droits de douane vont être imposés. La politique monétaire ne peut rien y faire. Ce qu'elle peut et doit faire, c'est d'empêcher que ces hausses initiales et directes des prix se propagent. On doit éviter que l'augmentation des prix causée par les droits de douane se transforme en l'inflation persistante et généralisée. En fait, on doit éviter qu'un problème de droits de douane devienne un problème d'inflation. Simply put, we need to make sure that a tariff problem doesn't become an inflation problem. So what do we do? Well, we're doing three things. First, we're tracking cost increases through to consumer prices. Once prices have gone up to reflect tariffs, a one-time increase, we want to see prices stabilize at that higher level, at least until tariffs are dropped. We don't want to see price increases become more broad-based or inflation expectations start to move up significantly. Second, we're improving our analysis to better inform our policy decisions. We've built better and richer multi-sector economic models, as well as models that better account for the links between Canada and the rest of the world. The bank is using these new models to analyze different tariff scenarios, and we've published a number of these. Finally, we're doing more outreach across Canada, both in person and digitally. We're being nimble with our surveys so we can reach Canadians and households quickly, and I'm taking advantage of this visit to Calgary. In addition to speaking to you, I've got a number of roundtables planned for the next 2 days. We can't reduce the uncertainty around U.S. trade policy, but we are doing our best to reduce the uncertainty about the impacts of tariffs, and all this work will feed into our monetary policy deliberations. Still, we need to confront the reality that, like everyone else, we are taking decisions against a background of pervasive uncertainty. This affects how we take monetary policy decisions. So let me explain. In normal times, when the Governing Council meets, we agree on an economic projection that is our view of the most likely outcome for the economy. That projection is based on economic data, on our surveys, and on the historical relationships that are built into our models. That's our base case. Then we discuss the risks around that outlook. There are always risks. And our monetary policy discussions are geared toward deciding on the best monetary policy given the most likely outcome for the economy and the risks around that outlook. But in a situation of pervasive uncertainty, it's very hard for any of us on Governing Council to have high conviction about the most likely outcome. Several outcomes all look plausible. And different people will weigh the various factors differently. That's natural. It's one of the benefits of having diverse perspectives around the Governing Council table. When we have this high degree of uncertainty around the base case, we give more consideration to the risks. Our focus is less about the best monetary policy for a specific economic outcome, and it's more about policy that works for different outcomes. To see why, consider the alternative. If we were to guess where the economy is headed and make policy to optimize that outcome, we'd risk getting it wrong. Our actions could be ineffective or make the outcome even worse. We need to set policy that minimizes the risk. That means being less forward-looking than normal until the situation is clearer. And it may mean acting quickly when things crystallize. We're going to need to be flexible and adaptable. Okay, you've been very patient. It's time for me to wrap up. I spent much of my time today talking about uncertainty. Unfortunately, the uncertainty we face is going to be here for a while. That is going to make it difficult for Canadian businesses to figure out their best strategy. And it's hard for Canadian families to plan for the future. But we do know a few things. The Canadian economy started the year in good shape. 5 years after the pandemic hit, we have come through an unprecedented global crisis and restored economic growth and low inflation. Interest rates have come down substantially. And because of that, we are in a better position to confront the risks ahead. Monetary policy cannot offset the effects of a trade war. What it can and must do is ensure that higher prices from a trade conflict do not become ongoing inflation. We are committed to maintaining price stability over time. There should be no uncertainty about that. Thank you very much.
Amazing. Thank you, Governor. So usually this is the part where I say, who the hell are you while you're here? But I think we know that now, so we can skip that part of today's formality. Just a quick update. Just remember that we do have a hard stop at 11:45, so we will be taking questions from you. So if you haven't downloaded the Slido app, please download it now. Get your questions in, and I will read them off as we go. Is that good? Awesome. And the other thing, too, on your questions, there's certain things, obviously, the governor cannot answer, sort of like he can't tell you when rates are going to go up or rates are going to go down or what the stock market will do, because I've already asked him and he said no go. So please, let's not do that. Thanks again for joining us. Fantastic information. I just want to go back to a couple things you just talked about. So chart number 2 and speed of data, which is really interesting from my perspective. You know, obviously the uncertainty, which is the theme, is part of this. But, you know, maybe can you help us maybe understand the part that, you know, monetary policy does take time to get through. So how do we factor this into your thinking? How does that come through on this? And how do we help assuage some of the concerns we have out there about what's going on right
now? Yes. Monetary policy needs to be forward-looking, and you know, to be frank, that's always a hard part of the job. I mean, you know, you're taking business decisions, family, you're taking decisions. We all have to be forward-looking. So it's nothing really unique. As you mentioned, monetary policy takes time to work. You know, we lower interest rates. You know, that feeds through the financial system. That part works pretty quickly, but it takes time to feed through to business decisions, to household decisions. It takes time for people's mortgages to reset. So, you know, that takes about a year on sort of the real effects of monetary policy on business and household decisions. That takes roughly a year to feed through, and then it takes about 18 months, and then inflation is determined by the pressure of demand versus supply. So if we lower interest rate, demand goes up. It really takes about 18 months for the effects to come through on inflation. So that's why we spend a lot of time doing forecasts, and we publish those forecasts regularly, so everybody can see what we think is the most likely outcome for the economy, and they can see what we're basing our monetary policy decisions on. There's always risks around those forecasts. There's always could be new developments. Economic behavior, it's not like, they're not laws of physics. Sometimes things go a little faster, a little slower. So there's always uncertainty, but certainly that central forecast is a very important input into our monetary policy decisions, and everybody can see, are things, over time, are things coming in line with the bank's forecast, stronger, weaker, and they can kind of assess, they can kind of think, they have a pretty good guess of what we're probably thinking about at the Bank of Canada. In the current situation, we're faced with a situation with pervasive uncertainty. So are all of you. So we're not in a situation, I think, where there is a single most likely outcome. There are a range of plausible outcomes. We could have, some tariffs, and they don't last too long. We get back to some. I think there is a permanent structural change, but the good outcome is after a lot of chaos, we get down to a serious renegotiation. We get a new trade agreement, and we can move forward. There are other much worse scenarios. We get broad-based tariffs that last for a long time. Those have very different implications for the Canadian economy. So in the current situation, we need to think about more than one outcome, and we need to think about policy that would work for more than one outcome. So that's how we're approaching things right now. And what we've said is, we're going to proceed carefully. At some point, things will get clearer, and we can get back to putting more weight, being more forward-looking, put more weight on that most likely outcome in our policy decisions. But as we work through this, we're going to have to be flexible and adaptable.
So speaking of flexible and adaptable, we do have a question in from the audience. I'm sure this is not going to be a surprise for you. But does the thinking, the strategy, the policy change depending on who's in power?
No.
Nice, easy answer. I like that. Okay, follow up on that one. So obviously there's been a lot of oxygen taken up lately about infrastructure projects that we need across the country. We need to open up things. We need to invest in large-scale opportunities. That's going to take a lot of capital. That's going to take a lot of spending from the federal government. How does that impact the thinking from a monetary standpoint? What does that do from the Bank of Canada's perspective?
Yeah. Well, just let me just actually put your two answers together. So the answer to your first question is no. The Bank of Canada operates completely independently of the political process, and that independence of monetary policy is an important feature of central banks around the world. And what we've seen over time is that that's the best way to get sound monetary policy decisions, preserve price stability. With respect to decisions about infrastructure investment, fiscal policy, tax policy, those are decisions that are taken by elected governments. They have implications for the Canadian economy. And so when governments announce changes in policy, we take those on board and we build those into our forecasts. And they, depending how big they are, they can have an impact on the forecast, and that is something that we would take into account as we take monetary policy decisions.
Fantastic. I mean, pulling on that thread again, one of the questions we've got in from the audience is about interprovincial trade. Does that have an impact? How does that play into the thinking? And can you provide any context around that?
Well, interprovincial trade is getting a lot more attention recently. That's a good thing. One of the very difficult features about a trade conflict is that this looks like a structural change. Let's hope we can get into a more rational negotiation and get back to a good trade relationship. But there's a certain level of trust here that has been broken. This looks like a structural change. What that means is that if nothing else changes, we're going to be on a lower path for our economy than we would otherwise be. We're going to earn less. We're going to consume less because we're going to have less income. The only way to offset a negative structural change is with positive structural reform. And there are a number of things we could do to strengthen our own economic union. And these are things we've been talking about for some time. Perhaps this is the opportunity to get them done. So you mentioned interprovincial trade barriers. Sadly, in some cases, it's been easier to trade north-south than it has across the country. There are too many small differences in regulations across country. There are actual trade restrictions, and there are also a lot of restrictions on accreditations for different professions: engineers, lawyers, accountants, nurses, doctors. They all have provincial accreditations. I mean, if we could cut through these, mutually recognize our regulatory, we could make it easier for commerce to happen east-west across the country. That would be a positive structural reform that could offset at least some of the consequences of this very negative structural shock we're facing with the United States.
I mean, it's not easy to replace 400 million consumers overnight, is it?
No, it's not easy to replace, and even if we do this, it will take time to have an impact. But there are estimates out there. People have been looking at this for some time. The estimates certainly vary, but all of them are they are big numbers.
One of the questions we've got in from the audience again is about the relationship you have with your counterparts around the world. Can you shed some light on some of those discussions? How does that look? How does that feel? And what are you hearing from other parts of the world outside of the U.S.?
Yes. So one of the good things about being a governor of the Bank of Canada is you do have a global community. The governors of the other major countries in the world, we get together very regularly. In fact, we were all together a couple of weeks ago in Cape Town, South Africa, for the G20 meeting. and the governors took the opportunity to meet amongst themselves while we were there. And we also, there's something called the Bank for International Settlements, which is in Switzerland, which is kind of the central bank for central banks, and the governors meet regularly there. And I can tell you, it is, unlike most companies where you're competing against your other companies, central banks, we're all in this together. So there is a lot of information exchange. And I can tell you through the last number of years where we've been dealing with an unprecedented pandemic, the biggest surge in inflation in 40 years, these were things that were happening in all our countries. And so comparing notes on what exactly are you seeing in your country, how are you measuring that, how are you approaching that, what are you thinking about in terms of your policy response, what are you worried about, that has been hugely helpful. And I will say that although we have a flexible exchange rate in Canada, as do most of the other countries, and what that means is that we can each gear monetary policy for the needs of our country. But when we show common resolve, it can help all of us. So, when inflation went up sharply, you saw all major central banks raise interest rates forcefully. We all demonstrated a commitment to get inflation back to target, and that helped us all. It reduced global demand for goods. Those supply chain constraints became less binding. Global inflation in goods came down, as well as service price inflation in each of our countries. What that demonstrates is we spent a lot of time talking about negative international spillovers, and we're getting some big ones right now. But when we work together, we can actually create positive international spillovers.
So you recently added an external deputy governor to the governing council. Was that, can you shed some insight into that as to the thinking behind that, what that role is, and what the outcome would be to have that extra sort of set of hands or eyes?
Yes. So this is actually the second external deputy governor we've added to the governing council. We had, if you go back a couple of years, we had six. There's four deputies, one senior deputy, and then me as governor. So there's six of us on the governing council. We went down to five full-time internal people, so three deputies, senior deputy, and me. We added one external deputy governor, and we've now added a second. So these are term positions, 2 years. They're 2-year positions, renewable for up to 2 years. And so why did we do that? Well, the reason was to get, I think, some more diversity of perspectives, to get some outside perspective. These people, both of these individuals, they're academics, they're economics professors. They're still working half-time as economic professors in the university, spending half their time with us. And I think from my perspective, it is working very well. It's bringing some freshness, some dynamism, and because these positions are going to turn over, you'll get some natural refreshment, some new perspectives. We were very pleased with when we had one. I think two felt more like a critical mass. And the other thing was it allows for overlapping terms. So you have, you're always going to have one external deputy governor who's fully up to speed, and I think two. I think we're not planning any more additions. I think we've got now a council of 7 in total, 4 internal, 2 external, and then myself as chair.
Interesting. So again, we've only got a couple minutes left, so if you have a question, please try to get it in. We'll try to get to it. Can we talk stagflation? Is it going to happen? Is it real? What's the thinking around that, and how do we adjust for that, or how do you think about that in the role that you have?
Well, sometimes you're a product of when you grew up. I grew up in the 1970s, so when people say the word stagflation, I think of like double-digit inflation and double-digit unemployment. So that's not what we're talking about. But yes, look, the reality is new tariffs combined with retaliatory tariffs mean a weaker economy and higher inflation. And what we're really looking at is, so a weaker economy is going to put downward pressure on inflation. New costs, new tariffs, a weaker exchange rate, supply chain disruptions, those are all going to put upward pressure on inflation. So, we're looking at both of those pressures, and we know that some prices are going to go up, and there's nothing monetary policy can do to stop that. What we want to make sure is that those one-time price increases don't spread to other prices and become generalized inflation. The weakness in the economy will act to dampen the effect of those price increases. So we're looking at both. We're assessing both these downward pressures and these upward pressures. It does mean that it's a very complicated kind of shock for the economy, and that's where you get the dreaded word stagflation. So yes, look, we are going to get some weakness in the economy. We are going to get higher inflation. We're going to proceed carefully to provide support to the economy, but without taking our eye off the ball of controlling inflation, because what we can't let happen is Canadians are facing already a lot of uncertainty. They can't have to worry as well about inflation.
Okay, because I'm a half full glass kind of guy, one last question. Is there a sector where you see some rays of sunshine perhaps happening?
Well, yeah, I want to come back really to, there's no question that this threat from the United States it's creating a Canadian moment. By Canadian, I think people are looking at their own behavior, and I think that's going to help us. I think we're also, as a country, having some discussions about things. We just talked about some of them. Some of the things that we could do actually to strengthen the economic union, to improve the efficiency in our own country. We've been talking. I mean, productivity has been a perennial topic. Canada has. We had pretty good boosted productivity growth in the late 90s, but to be very frank, since about 2000, our productivity growth in Canada has been weak. And unfortunately, there's no silver bullet. There's no one reason, okay, fix this and the problem's solved. I think it's a combination of a number of things, but certainly there are a number of things around removing interprovincial trade barriers, trying to streamline and make the regulatory approval process more predictable. These are things that would make Canada more investable. We need, a lot of our geography is, most Canadians live not that far from the U.S. border, so our transportation links, many of them are north-south. We need to strengthen our east-west transportation links. We need to build out our ports to improve our ability to get goods to foreign markets. And some of these things weren't as much of a priority when we had a trusted trade relationship with the United States. They are a bigger priority today. And so, I think, look, it's not up to the Bank of Canada, but what I can tell you is that the more, productivity growth is a wonderful thing. Productivity growth means for every one of your businesses, you're more competitive. You're going to grow your profitability. You're going to grow your market share. For Canadians, it means higher wages. More productive workers earn higher wages. Higher productivity pays higher wages. For governments, it means their tax base is going to be growing without their cost base growing, because the economy is growing, without needing a lot of extra things. The tax base is growing. And for monetary policy, it means the economy can grow faster without hitting those limits that lead to inflationary pressures. So, I think if there's a silver lining, it's that we put more focus on productivity, more focus on strengthening our economic union.
Fantastic. We're at our time. I know the governor's got a huge schedule here. I want to thank everybody for coming out today. Really appreciate you taking the time. I want to thank our Team Calgary partners for, again, supporting the work that we do. I want to remind you of Report to Community on April 2nd. If you haven't registered, please do so. But more importantly, please thank the governor for spending time with us today. Thank you, sir.
Thank you.
Good job.
Sean Gordon. I'm a press officer at the Bank of Canada, and I will be moderating the news conference. Governor Macklem will be pleased to take questions for about 20 minutes. Before asking your question, please state your name and affiliation. We're webcasting this press conference, so please use the wireless microphone, which my colleague Yan will be passing along. We also have several journalists who are participating remotely today, so we'll do one question per outlet. To start here in the room, and then we'll turn it over to the teleconference. If there's time left over at the end, perhaps we can entertain follow-ups. Yeah, that's about it. The governor will be happy to answer questions in both official languages. Avant de poser une question, prière de vous identifier. Je vous demanderai également d'utiliser le micro sans fil. Libre à vous de poser vos questions dans la langue officielle de votre choix, bien évidemment. Governor. Who's going to be up first? Go ahead.
Yes, the February inflation number did come in higher than we were expecting. We were expecting something more like 2.3. It came in at 2.6. And the previous month, although the overall number was largely as expected, the details were a little firmer. So, yeah, it's got our attention. In terms of looking at it, a good part of the increase was expected. We all know that the GST holiday was ending. That's half off in February, so we were certainly expecting to see inflation move up, and it did. There were some, as there often is one month to the next, some special factors. Travel tours in particular, which tends to be a very volatile component, were up very sharply in February. Looking to March, I think a week ago at the press conference, I said we expected CPI inflation to be around 2.5% in March. That's still roughly what we're expecting. So, we'll see where we are in March. So, at this point, it hasn't fundamentally changed our view. There's often some volatility month to month, but as I said, it has got our attention. If you just kind of step back, what you're seeing in inflation is shelter price inflation is still elevated, but it has been coming down pretty steadily, and we expect that to continue. We know we've lowered interest rates. We know that'll feed through to lower mortgage interest costs. Rent, we can see that when apartments are turning over, the new rents, the rate of inflation's come down considerably. That feeds through to the stock. So we do expect shelter inflation to continue to come down gradually. Goods price inflation, which has been abnormally low, has moved up, and what you're seeing in the last month is it moved up faster than shelter came down. So we're going to be watching that evolution. As you mentioned, going forward, there is clearly a new element, and that is the impact of tariffs, and also just the impact of uncertainty. I mean, as I stressed a week ago, we are hearing from businesses that uncertainty itself is adding costs, and somebody's got to pay for that. So, we will also be looking for evidence that we will be tracking how consumer prices are affected by tariffs, how they are affected by uncertainty. I don't think we're really seeing that yet, but that is something that we will be watching for going forward.
Go to Chris. Go ahead.
Hi, Governor. Chris Varco with the Calgary Herald. You mentioned in your speech, you talked about the regional impacts and the sectoral impacts that tariffs would have, and you specifically talked about Canadian energy and oil and gas. And I'm wondering, where do you see the biggest impacts and how they would unfold, whether that's through the commodity prices for Canadian producers or investment levels, or whether that's employment or even longer-term Canadian energy maybe being displaced by other sources?
Well, I think near term, probably the thing that gets affected the most quickly are investment decisions. And, what we're hearing from businesses broadly, not just oil and gas, is that the elevated levels of uncertainty, the unpredictability of U.S. policy has caused many businesses to sort of say, kind of call pause. They're waiting for more clarity as they decide on big investment decisions going forward. So I think that's where you're going to see it the quickest. You'll probably also, depending on what happens with tariffs on oil, you'll probably see some impact on prices. We've seen that in the markets react very quickly. These are spot prices. We've seen when President Trump has put tariffs on, we've seen that have some price impact quite quickly. So, if there are tariffs, U.S. consumers will probably have to pay more, but there'll probably be some discounting from Canada. So you get lower prices, that gets you lower income. For the energy producers, there is some offset to that because we've seen some depreciation of the Canadian dollar, so they're getting more. That brings more American dollars per or in Canadian dollars worth more. So that provides some offset. I think what you're specifically with energy, we're still exporting a lot of energy to the United States. There is more uncertainty. So far, we have not seen big impacts, and hopefully, that trade relationship can remain secure. The reality is, the Midwest of the United States relies heavily on Canadian crude, and it is set up to refine Canadian crude. The transportation pipeline network, which both have been invested in on both sides of the border. U.S. has got a lot at stake here as well. So this is mutually beneficial. It would only make sense for both countries to maintain that mutually beneficial relationship. But not everything that happens makes sense, and I can't deny there's some uncertainty.
Is there anyone else? Go ahead, Edward. Yeah.
Edward Jan from City News. Governor, there's been a bit of talk down south of a recession because of the tariffs. Could we see a recession in this country if we continue to be in a trade war with the States, or does even the prolonged uncertainty of tariffs could just be enough to cause a recession?
The reality is there is a broader than usual range of possible outcomes. As I just talked about, uncertainty itself is having an effect, but certainly I think on this, you look at the range of outcomes, it's not a good outcome, but on the range of outcomes, not as bad outcome would be, yes, we have a prolonged period of uncertainty with some new tariffs, but those don't last very long. Those get removed. We get more clarity. We get back to some sort of predictable trade relationship with the United States. But even going through that period, I don't think we'll have a recession in that scenario, but we'll certainly have lower growth. You'll see some more pressures on prices. So a difficult scenario, but there are certainly much more difficult scenarios that are possible if there are broad-based tariffs, either universal tariffs as were twice imposed and retracted, or simply tariffs across many sectors. So it starts to affect many parts of the economy. So if you get broad-based tariffs for a long time, yes, that could very well lead to a recession. So there is a broad base of outcomes. I think from a monetary policy perspective, what we're really looking at is less about, focusing on a single outcome, a single forecast, and having to think more about the range of outcomes and how do we set monetary policy for a plausible range of outcomes.
I think we have at the back of the room here. Go ahead.
Drew Miller, CTV Calgary. Just heading into the upcoming federal election, how confident should Canadians be that inflation is under control?
Canadians can be confident about our commitment to maintaining price stability. Now, what do I think this will look like for Canadians? Look, if there are significant tariffs and retaliatory measures, some prices will go up. And what that means is that you will see overall inflation will go up for a period. But here's what I would stress. I think Canadians can be confident that that increase in inflation will be temporary. We're not going to let a tariff problem become an inflation problem. And what does that mean? What are we really looking for? Some prices will go up. Monetary policy can't change that. There's going to be extra charges at the border. Canadians will have to pay that, so some prices will go up. What we're really watching is that those price increases are simply one-time price increases, at least until the tariffs are in place. If the tariffs come off, they should come back down. What we don't want to see is we don't want to see those first-round price increases on some goods start to spread to other goods and services and then become ongoing generalized inflation. That's what we're very focused on. We've been through a lot in the last 5 years, and we've demonstrated that we can use our instruments to control inflation. The other message I would have is that, look, as difficult as this is going to be, the Canadian economy is coming into this in a good situation. We've had inflation around 2% since last summer. The Canadian growth in the Canadian economy picked up pretty smartly in the second half of last year. We started the year in good shape, and we've lowered our policy interest rate substantially. Now 2.75%, very much in the middle of the what we call kind of the neutral range. So, look, this is going to be difficult, but we do think we are well positioned.
I think that's it for the room, so perhaps we'll move to the teleconference. Just a gentle reminder to please stay on mute until it's time for you to ask your question. So we'll start with Promit Mukherjee from Reuters, followed by Craig Lord from Canadian Press. Go ahead, Promit.
Good afternoon, Governor, and thank you for taking our questions. You have a very interesting line in the speech, and I quote, you say that, the quote, and it may mean acting quickly when things crystallize. Well, I wanted to ask, what do you mean by acting quickly, and how do you want to do it?
Well, I think you want to read the whole paragraph and not just that one sentence. So let me, what was the message there? I mean, the message really is that, as we've just talked about, there is a range of possible outcomes. Normally, the Governing Council comes together, we agree on what we think is the most likely outcome to the economy. There's always risks around that, and we factor those in, but we gear monetary policy more around the most likely outcome. We're currently in a situation where there are a range of possible outcomes, and I don't think anybody in the Governing Council can have very high conviction about what the most likely outcome is. So we're really looking at setting policy to deal with a range of outcomes. Now, at some point, I don't know when that's going to be, but at some point that uncertainty is going to go away, and it's going to become clear. And at that point, I expect we will move back more to a central outcome, a most likely outcome, a single projection for the Canadian economy. And really the message there is that we're going to need to be flexible and adaptable. Right now, there is no single most likely outcome. There's a range of outcomes. We've got to factor that into monetary policy. As things become clear going forward, we'll go back to more focus on a single outcome. So we're going to have to be flexible and adaptable. And when things become clearer, then as things crystallize, as things become clear, that could affect our policy decisions and what we decide to do. I think right now our message is There's a lot of uncertainty. This, a trade war means weaker growth and higher inflation. There's both downward pressures on inflation from weaker growth and upward pressures from new costs. So in that environment, we've said we're going to be proceeding carefully with any further changes to our policy interest rate.
Thank you. So go ahead, Craig.
Thank you, Governor, for taking our questions. We know that there's significant uncertainty tied to the U.S. tariffs. China today launched a new wave of its own tariffs on Canada. Could you speak about what that means for your decision-making and for the Canadian economy more broadly?
Specifically with respect to China or with tariffs overall?
With respect to China and what kind of layers of uncertainty that adds to the situation?
Yes. Look, I mean, stepping back, unfortunately, and this isn't just a comment about Canada. I mean, stepping back globally, you're seeing increased economic fragmentation. You're seeing increased protectionism, increased use of tariffs around the world. That is not good for global growth. We've had a long period where all our economies have benefited from the tailwinds, from peace, from globalization, from increasing integration, from demographics have also been a tailwind. Unfortunately, those tailwinds have all turned into headwinds. Coming back to specifically Canada, we are somewhat squeezed between tariff conflict with the United States, tariff conflict with China. There's no question, this is having an impact on the Canadian economy. It would certainly be better for all of us, all of our countries, if we can get back to more predictable, secure, open trading relationships. Having said that, the world has changed, and economic security is going to have to factor more into trading relationships. So we probably can't simply go back to where we were, but tit for tat tariff escalation, an increasing, escalating global trade war is in nobody's interest.
Thank you. So we'll go to Max Sato of Mace News next, please. Go ahead, Max.
Thank you, Governor. Following up on your earlier answers about your comments that you have to be less forward-looking than normal until the situation is clear and may have to act quickly when things crystallize. Does it mean there's a higher possibility than normal of a rate decision between the scheduled announcements, and accordingly, Canadians will have to act quickly to take care of our finances?
That was not the message I was trying to convey with that. The message I was really trying to convey is we are in a very unusual situation. Uncertainty is much more pervasive than normal, and that's affecting how we're going to take decisions. And just to sort of lay that out for you a little more clearly, right now, so a little less from a month from now, we are going to have a new monetary policy report. And normally in those monetary policy reports, we have a pretty elaborate projection for the Canadian economy, GDP, inflation, the components of GDP, and there are always risks around that projection. There could always be new shocks, new developments, and our economic. There's always some uncertainty about how quickly things are going to move in the economy or how slowly, and so we discuss the principal risks around that projection. Right now we're working on our monetary policy report for April, and a lot can happen between now and when we publish that report. We've seen how quickly things can change, and obviously we're very focused on what the U.S. says on April 2nd around reciprocal tariffs, what that means for Canada, what that means for other countries. So we'll see. At this point, it's pretty unclear. But, you know, if we were to prepare that monetary policy report today, I don't think it would have a single central projection. It would probably, you know, I think right now we're thinking about a case where there's some tariffs with a lot of uncertainty for a period which eventually dissipates. We're thinking about, you know, on the other end, you know, much more in the much worse outcome space, broad-based, long-lasting tariffs, and then obviously there are a lot of possible outcomes between those. So, you know, I'm not going to commit right now what you're going to see in April, because a lot of things we know a lot of things can happen. But you know, I think one thing you could see in the monetary policy report in April is that we don't have a single central projection. We have, you know, we look at a range of outcomes. Certainly, as I said, you know, that is how we're thinking about policy right now.
I think we're going to squeeze one last one under the wire if we can. Paul Vieira of the Wall Street Journal. Go ahead, Paul.
I want to go back to this week's inflation report.
Paul, I'm just going to stop.
We can't really hear you,
Yeah,
Paul.
we can't hear you, Paul. Perhaps we're not going to squeeze one last one in after all. I apologize for that, Governor, and I apologize to people in the room. Sorry, Paul. Get you next time. And that concludes the press conference today. Thank you so much for coming and being with us. Thank you.
Sorry, Paul. Thanks very much.